Well, this is great to be back on StockCharts.com. I had a report earlier this year. It was partially right and partially incorrect. Some of you posted some messages, and I always follow those messages and try to reply to you. Don't think I'm always right in the market. Got a pretty good track record, but anybody to try to predict the future that goes out on a limb, as I did in that last report, it's not going to be perfect. The future is largely unknown. We can get a pretty good idea of it. I'll show you what the predictions were that we made. You can see how it actually panned out. So I'm willing to stand up to my past performances. And then I'm going to show you what I think is coming and why. And more importantly, are we in a bear market? Is a bear market about to start? And what should we be doing? And also stay with it because we've got a really strong trade coming up for you that will take place at the end of June. Well, in my last presentation, I expected a market peak in early April, leading to a bottom in early June. The fundamentals said this is not the start of a bear market, not yet. We're very clear about that, that while all the Cassandras, the purveyors of pessimism are out there saying it's the end of the world because of Joe Biden or whatever, Donald Trump, no, we're in a bull market. We're going to stay in a bull market until, I'll show you that in just a little bit. So this is how it actually came out. We said there would be a market top around the early part of April. Well, that's the early part of April, and this is where we are right now looking at triple Qs. Now, the E-minis were clearly stronger, but the more speculative stocks, the triple Qs, the NASDAQ, really did make that peak, went down, and they haven't made new highs yet. So a little difference in which markets have been the strongest here, which is a real interesting point for us, because the NASDAQ are not the real value stocks as, say, the Dow Jones Industrial Average. So value has been stronger here than speculative stocks. Whoa, is that positive? That's really positive because it means funds, big players want to buy value. They want really strong performing companies. They're not as interested in speculation, which means that the market has been much more selective. As you can see, no new highs in the triple Qs of the NASDAQ, but new highs in the Dow Jones Industrial Average. We talked about how we can measure the internals of the market structure by looking at advanced decline line and the forecast. This is from the report I did in March, middle of March, said we should start to see the market dip a little bit, come up, and then come down into that mid-June buy point. In other words, we can look at cycles, not just the price, but the advanced decline line. That was the forecast we made. We've been pretty much on target with that forecast. But I want to share with you today what I think is the secret of using cycles. Cycles don't predict trend. This is where people get all messed up with cycles. They predict inflection points. They predict times to expect strength, expect weakness. They're not necessarily going to call tops and bottoms. Let me show you. Let me explain that why. Cycles are, we can see in the black line, that's a cycle, whatever the time period is. But prices, will they generally follow those cyclical highs and lows, have trend to them? And just because we see a cyclical high doesn't mean we're going to have a massive cyclical drop. Here we should have a big drop, it looks like, right? Because cycles go from high to low, low to high, but price may not dip very much or it may not rally very much. So you're very confused. This might help you a little bit better. Here's the longer term cycle. It's been really effective in the market since 2018. But notice it called for cyclical high here. Well, we didn't have it, but we had an inflection point. Yeah, the market stopped moving up from here to here. Same thing over here. And there's our inflection point on the buy side. So the fact that cycles go high to low, low to high, doesn't mean the market will do that because market has trend involved also. So even in this uptrend, cyclical low, we want to be very positive in the market. Here we have a cyclical high and the market comes down quite well. So the market may come down with the cyclical projection or it may not, because that's the trend. That's why we still need short-term technical analysis to see, is the market weak here or it was strong back here and strong here to tell us, are we going to get this magnitude of the decline? So keep in mind, just because we see a cyclical high or because we see a cyclical low does not necessarily mean we're going to have an equal move to what you see in the upline and the downline in the charts. It gives us the inflection points. It tells us when we should be looking now. I think around the 17th of July, it looks like the next inflection point. You can see these points, nice rally starts, nice rally starts, nice rally starts. So we get through June here, and we'll talk a little bit more about that. I'm going to expect a pretty good rally in the marketplace, a cyclical inflection point. A buy move to the upside side should begin probably around 4th of July, maybe a little later. These cycles are not specific, but generally we see, that's the next cyclical inflection point for a buy signal in the Dow Jones Industrial Average. Now, another way we can look at this is to look at the seasonal patterns. Now, I do have my true seasonal index, which is unlike any other seasonal index that you've seen or anybody else offers in StockCharts.com. It's right there for you. This was a cyclical projection. This is what should have happened. This is what's usually happened in the triple Qs. Oh, a low right here. We saw it. Market runs up, it goes sideways, which is what's happened. And then we start to see around the 1st of July, we start to move back to the upside. So again, let's call that an inflection point. That may be more clear than some of the terms I've used in my prior stock charts presentations. So hopefully that'll give you a sense of that. That's what we typically would expect on a seasonal pattern in the market. Well, this is the seasonal update. This is coming about the end of June, it looks like. The true seasonal pattern, this is for the Dow Jones Industrial Average, really kicks in. Notice a little drop we see at the end of June, a lot more about that trade coming up. So there's cyclical low. Oh, nice buy point. Cyclical or seasonal low coming up. We want to be prepared for that opportunity. So recap of seasonal patterns, we usually rally at this time of the year, but the last 5 years show it's a choppy pattern. It's kind of mixed. You can use this on intraday basis. By the way, if you're an intraday trader or follow the markets on an intraday basis, my cycle projection is in StockCharts.com. Now we're looking at a 15-minute chart of essentially the S&Ps, the SPYs, right? And this red line is known 66 bars in advance. In other words, we knew at this point, 66 bars prior to this, before this market action, we knew it. Well, let me show you what that looks like. See, we can see this index predicts into the future. This is right up to today's. I'm using a 15-minute bar chart. And the forecast as well would dip a little bit, start to rally, dip down, and then suddenly we should jump up in the market, just as we did today. So these short-term cycles can also be helpful if you're a day trader or follow the markets on an intraday basis. And that indicator of mine is in StockCharts.com. Okay, let's talk about fundamentals, because fundamentals are really weak at timing market swings. They're not very good for that, but they give you the conviction you need to hold on. You know, we've been bullish, long-term bullish in this market since March 2020 because of fundamentals. Now, the fundamentals don't tell us how the market is going to swing, but I've had that fundamental, very bullish belief, and so many of you wrote me some rather scathing emails and comments on YouTube, which is fine. That's the marketplace. I'm prepared to handle that because your fundamental view wasn't correct. You had this fundamental innate bearishness that most people have. But my bullish view has been, I believe in this, and that's what's kept me long. So this is how fundamentals really work. Prices go from A to B because of fundamental reasons. That's really what happens, okay? But along the way, these erratic activity happen. That's the emotions, the news of the day, the technicals. But if you really believe, then you're not going to, you might be a buyer back here, you won't be a seller here, and you won't be shaken out when prices go crazy because you have a fundamental belief of the marketplace. Really important that you understand that's the way to use fundamentals. Tommy Lasorda really said it best. Tommy Lasorda was great baseball manager for Los Angeles Dodgers, perhaps one of the best pitching coaches ever. I just love this quotation from Tommy Lasorda. Tommy said, "God may delay, but God will not deny." He had to cut a kid from his baseball team, and he said to this person, and we can just substitute value. Value may be delayed. We may not get rewarded for value right away, but value will not be denied. Ultimately, in the stock market, value will be rewarded. So if you have that fundamental view of the marketplace, you're way ahead because you have the conviction to be a longer-term player. Remember, one of my key understandings of the marketplace is that trend is the basis of all profits. No trend, you're not going to make money. What trend is caused by valuation? But trend is a function of time. The longer you can be in a trade, the more time you have for trend to take place. So time is our ally. That's why day traders have so much trouble. They have a couple hours to make money, but a longer term player has time to manufacture some massive trend. Look at the big trend moves we've had in a lot of these stocks because the valuation has driven those trends. So trend and time are really important for investors. Well, I've changed or added a new twist to fundamentals I'd like to share with you. We've talked about this before in these StockCharts.com presentations. And I think that what happens to crude oil, gold, and bonds affects stock prices a little later down the line. Now, is this correlation or causation? I think that's causation. I'd like to show you some things I did in the last forecast, which was done in March, as I recall. And this was our crude oil forecast based on a weekly chart. This is all we knew back then. Well, as you know now, prices have gone higher. They've followed essentially this forecast that we saw based on crude prices. When crude prices get really high or really low, it clearly has an impact on the economy. I mean, crude oil drives the world economy, right? So that's how we can use one market to help us understand another market. Now, this is the crude oil forecast right now. I'm looking at a daily chart. Look at the nice correlation between these. It suggests a sell-off is coming into the July time period, and then we start to rally again. So we get a bit of a fundamental sense here that we may be seeing a decline in the marketplace and/or because again, like in cycles, this predicts we should rally, oops, we should decline. It doesn't predict the magnitude of the move, but it says right now we can be looking for some sell signals in the market. We're going to look at that intermarket relationship I showed in my last presentation as well in gold. I think gold has a huge impact on what happens in the future stock prices. You can see this going back to 2014, and this red line is known a long time in advance that gold pretty well followed that relationship of gold. There it is. Look at that. Stocks are really, we called the April low in 2020 in part because of what gold is telling us. Now, this is the gold forecast I showed in the last StockCharts.com report a couple of months ago, and look what it was telling us. We should move higher, and we have moved higher. So there's a new way of looking at fundamentals to find the correlation of how much gold leads or crude oil leads can give us a general idea of the roadmap, the general path that these prices are going to follow. And I think that's just really a really nice tool for us to have. So let's update that. Here's the gold intermarket forecast. I showed you my crude oil intermarket forecast, right? Here's the gold intermarket forecast. As you can see, it's also suggesting a bit of a dip here. Hope I look at that around the middle part of July. We go back to the upside with some pretty wild gyrations coming in October, November, it looks like. And again, you can see, remember, this line is predicted into the future. So this high was known about back here, 2 quarters prior to it taking place. This low that we called last April, we knew that, April 2020, we knew that low should happen a couple of quarters, half of a year in advance of it, just as we now see a general path that we'd expect stock prices to take. Notice, look, neither of these suggest a big bear market coming, not yet at least. So we have some fundamental drivers of stock prices here that are telling us we still have some good times ahead. But there are some things that disturb me. So I want to address those with you because I think we cannot be perpetual bulls. We can't be, dreamers about this stuff. And one of the great tools, thanks to StockCharts.com, available on the internet, is the bearish, the yield curve. Now here's the yield curve in 2007. This is the curve over here. Look at that, flat, flat, flat. A flat yield curve, especially downward, it turns down, is really bearish for the marketplace. That's one of the great indicators that called the massive decline we saw in 2008. So you're probably wondering, where is it now? This is where it is in the last report that I showed, and bring it up to date. This is where we are now. We've got a little bit of a problem. We're still uptrending, but not much. So you want to really watch this. If this red line, the yield curve, starts to go down, and we've been in this bull bear market, that's going to be a real negative. So that's when you want to watch. It hasn't happened yet, but this last reporting period is not as up sharply as it was, right? So we're going to watch that one quite carefully. So Where are we today? The deficits, I talked about this last time, and this has been deficits and inflation, deficits and inflation. My gosh, everything I get, everyone I talk to, that's what they want to talk about. So I'm going to talk about deficits, and a little bit I'll talk about inflation. I showed this chart in my last presentation to really make it simple. What does deficits mean? Why are they bad? Why are they good? A deficit means there's more money in circulation. It means more debt too. So that can be a negative, but it also means there's more money in circulation. More money in circulation is quite bullish. More debt does not seem to matter because we have a fiat currency. We are not on the gold standard. So we have to quit acting or investing like we are. All the purveyors of pessimism again are saying, oh, all these deficits are horrible. Well, the deficits have gone up continually since I was born in 1942. They're always at a new high, it seems. And we're continuing to be in an uptrend in the marketplace. So I am not a deficit hawk like so many people were. At one point in my life, I was, by the way. I thought deficits were really bad. But then I did a study. And in my study, I found that the larger the deficits, the bigger the stock market moves to the upside are. So don't get carried away with all these people saying the deficit is going to ruin the economy. We'll have to figure out how to pay down the debt, maybe, or maybe we'll kick the can down the street, which is what governments usually do. But at this point, you cannot use that as a measure of bearishness. Well, I think the master indicator of what's going to happen in the future in the stock market is, can we predict a recession? And nothing that I know does it better than the unemployment index. Here's the unemployment index going all the way back to 1950. These gray lines you see here, that's when we had recessions. What happens at every recession? We see the unemployment index start to turn up. People start to get laid off, just like we saw before the big decline last year. So every single time we've seen a recession, unemployment has started to increase. Thus, we really, really, really need to pay attention to unemployment. Now, it's a little hard to see on this chart because it's such a long-term chart, but if we look at a closer up basis, this is weekly data, monthly data, of course, look at what's happened. Unemployment kicked up. We ran into a very quick recession, stock market bottom, down we came. And as I talked about this repeatedly in my presentations for StockCharts.com, we continue to see this down and down and down. We have not seen an uptick in unemployment. If we do, that's a negative. But for now, it's not happening. So we can't get carried away on the bearish side, because the best indicator to predict recession that I know is what you're looking at right here, right now, the unemployment report. And that's telling us we don't have any problems ahead. This chart really intrigues me. This is kids. The labor participation market of 16 to 19-year-old kids. And look at it's a wild number, but if we smooth it out, that's a smooth dashed line. Again, this is from the Federal Reserve System. Kids had the most jobs around the end of the 1970s, and consistently has been coming down and down and down. Kids 16 to 19 that have not been getting jobs. Why? Are they too lazy to work? The parents have money? Or is there another reason? I think the reason probably is we've had a very substantial increase in minimum wage, and you can't afford $15 an hour for a kid who has no skills. So it's been very hard for kids to get jobs. So if your children can't get jobs, or you're a young guy in the marketplace, you're wondering about it, I suspect that's the real reason. It's pretty hardcore data that suggests the people that are hurt the most by higher minimum wage are young people that really need to get some job experience. Well, where are the jobs? Where are they coming from in this economy? Will that tell us anything about the economy? I think so. The last jobs report that came out, the biggest increase was leisure and hospitality. In other words, restaurants and hotels are opening up again. Look at that. They added 292,000 jobs. Education and health services added 87,000 jobs. And the third biggest increase we saw in government, they're always increasing jobs, but clearly leisure and hospitality, we've started to open up this hangover of COVID. We're starting to get rid of this. God willing, we're not going to have another kickback effect, another upswing in COVID. And we can clearly see evidence here of 292,000 people went back to work because the economy is opening up again. The economy opens up again. Is that bullish or bearish for the stock market? What do you think? I think it's bullish. Well, how is the economy doing right now? Gosh, as I've said, the Federal Reserve has so much great information. Here is their leading index of the economy. And notice where it's been. Again, these gray lines are recession. Every time we've had a recession, it's come down precipitously, close to zero. Big decline, big decline. We had a recession. Well, look where we are now. We're not even close to being a decline. We're straight up. I mentioned this in my last presentation. The leading index of the economy continues to be very bullish for the economy, which of course is bullish for stock prices. The Federal Reserve does another interesting index, is how much stress is on the economy. Stress is interest rates, unemployment, CPI, a lot of stuff. And well, look at the recessions again, picked up before a recession. And where we are now, we're not in the pickup zone. So we're in a really good place for this. If you doubt any of this at all, my friend Bill Rafter does tax facts. This is payroll tax receipts growth. Notice as payroll receipts tax, people were not earning money. Tax receipts were not as much. Starting around the first part of 2020, we were in a big downtrend. Then we turned up, and as long as we're going up and up and up, people are paying taxes, they're going back to work. So that tells us, remember that unemployment is so important, that people are being employed, and despite whatever you think of the government numbers, this is dollars going into the treasury, people paying taxes, straight up trend, incredibly bullish. And this intrigues me. Look what people are doing with their money. This is the credit card delinquency, and they've been paying off the debt. But when this recession started, this little blip that we had last year, they continued to pay off debt on a precipitous, rapid basis, didn't they? So that's really good news. People have paid off debt, which means they can get back into debt too, which they're going to have some buying power when they think they're confident enough about the economy and their job situation. They can get back in buying. There's going to be more consumer demand. Oh, I know, the fear of inflation. This is on everybody's plate, isn't it? Inflation is going to eat up all of your money. Well, let's talk about inflation. Where's inflation going to go? Let's take a look. Well, here's the median consumer price index. And notice that as it gets high, the gray line again is recessions. We get high, we go into recession. We got a little bit high. We have not come up real high yet, but can we give an absolute measure for that, a specific rule? Absolutely, we can. Here's the consumer price index of all urban consumers. That's the blue line, and the red line is less food and energy. And my experience, and I've noticed this in my writings for many, many years now, when inflation gets above 5%, look what happens. We have recessions. So we're not there yet, but we want to watch this. This is another thing we need to watch, right? When we start seeing inflation numbers over 5%, yield curve starts to turn flat and down. We got some problems ahead. Now, that's not happening yet, but what I love to do about these shows is to educate you, show you so you know in advance, you understand how these markets move and what moves these markets. The S&P gains an average of 0.5% a year when inflation is above 5%, compared to an overall gain of 5.3%. What a difference, right? It's really hard for stocks to gain when inflation is above 5%. So here's the inflation forecast from the Federal Reserve Bank of St. Louis. They think we're going to continue to see an uptick in inflation, getting up to about 2.5, 2.7% maybe in September. And then January 2022 should start to come down. They've been pretty good at forecasting inflation. The interesting point is they're not forecasting 5% inflation, are they? There's another way of looking at the Aruba term structural inflation from the Philadelphia Federal Reserve System. If we look at May 2021, April, and May 2020, May 2020, they were suggesting going out in months, we would increase, and we have. But the May 2021 says months ahead, going out 24 months from now, about 2.3%, 2.2%, 2.3, somewhere in that area. So it also is not suggesting that this inflation that we've seen is going to go much farther. But again, we're going to look at the CPI because that's a real number. And the projections are suggesting that we're not in trouble, but Again, we'll go back to that CPI, right? Getting above 5%. So watch the CPI index. How about a look into the future now? Let's do that. Let's wrap up with that. Here's my cycle forecast for gold. Gold can have a bit of a dip here, and then I think we're going to sell off later, probably a little time after August. That's a general idea of the cycle's been at work in gold. A low point coming up September, October time period in gold. Crude oil. Crude oil looks like it's going to continue moving higher until, maybe sometime into the October, November time period cycles for crude oil. And again, remember, these are inflection points. They don't tell us the magnitude of the move, but we should be in an uptrending market until somewhere later this fall. And of course, I hope that StockCharts.com will invite me back to update these forecasts. The Treasury bonds look like we're going straight up in here. The next cyclical inflection point is about 3 months away. So I am long Treasury bonds. I want to stay long Treasury bonds. I want to buy Treasury bonds on a pullback, in part because the cycles say we should see a rally in this market, and this rally should continue. Hope that gives you an idea. E-mini forecast, yeah, we should drop down and then come right back up, so you can get prepared for that. Crude oil, we talked about crude oil leading stock prices, so you're aware of that one as well. I'll be looking for the money flow index. My money flow index is in StockCharts.com. We're linked triple Qs here. And notice that when the big guys start buying, look where we are. Look where we've been. So if we see the big guys start buying again, my money flow index shows big money is buying, then that's going to help us find the next turn to the upside in stock prices. Okay, get ready for this. Get ready, guys and gals, for a decline in late June. This is the typical seasonal pattern that happens in June. We dip in here, but look what happens around the 18th or 19th of June. We usually have a sharp decline in the marketplace. How sharp? Let me show you. There is the June sell-off in 2020. There's 2019. We didn't have much of a decline, did we? A little bit, not much. Doesn't happen perfectly look at 2018. Wow, we came slamming down here. 2016, all of a sudden the market looks strong. Boom, big break in the marketplace. So the June sell-off is this. You want to be a seller of the S&P E-minis about the 8th trading day left in June. If you do that, in the last 22 years, that trading has been successful 21 times, 95% of the time. So this seasonal pattern that we see here has really happened year in, year out. I call this my Machu Picchu trade. Some of you already know about this, but we have the Machu Picchu trade coming up the end of June, year after year. Go look at your charts. Never take my word for any of this. Go look at your charts and you're going to see, we start to decline around the 8th, 6th, 7th, 8th trading day left in June. Now, if the market's been a strong decline, it's been coming down already, probably trade won't work or won't work as good. But if the market's rallying, it looks pretty good. I really like to be looking for this sell point because I think we're going to get another short-term sell point around the 8th trading day left in June. So there's a trade for you. There's a recap of what I think's in store, and I hope I've been able to help your understanding what moves stock prices to the upside as well as to the downside, and help give you a little bit of a glimpse to the future. Hope you enjoyed this presentation. Please feel free to make any comments on the YouTube video repeat stuff, and I'll try to answer those as well. So this is Larry Williams, wishing you, until next time, good luck and good trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.